Okay, now it's time to go into the Financial 15 part of our weekly webinar, and today we're going to talk about IRMAA. So what is IRMAA? IRMAA is the income-related monthly adjustment amount, and that is the amount that is added to your basic cost of Medicare when you earn what the government deems is too much money, or when you have too much modified adjusted gross income. Not even how much you earn. You might be retired and completely not, just drawing funds out of your investments, but whatever the government deems is too much money will affect your Medicare payments in the form of IRMAA, income-related monthly adjustment amount. So we all know we have an Uncle Sam, but too few people know you have this Aunt Irma that will potentially have big effects on your retirement cash flow. And we're going to go over the brackets in a second. These do inflate from year over year. They're adjusted for inflation. So that's a good thing. But this is an area where I think there's going to be focus when, the problems that we have in our country's financial situation, when they really come to a head, we're going to start seeing more and more people affected by these surcharges that are known as IRMAA. So why IRMAA? So the question isn't what's IRMAA for? Well, we know that IRMAA, the government uses the extra funds that they draw from IRMAA to help close that gap, because we know that Medicare is the trust fund is set to run out of funds within the decade. We know that. So that those funds go to zero, and only a percentage of the Medicare benefits will be able to be paid if nothing's done by then. But why IRMAA? IRMAA is, again, triggered by a modified adjusted gross income. So if your modified adjusted gross income is too high, what the government deems is too high, you will have this IRMAA. So what causes IRMAA? So here I am. I'm going to just make an adjustment here so I can look down and draw on this. What causes IRMAA? I've talked about modified adjusted gross income. So that is your adjusted gross income with a couple things added back in. So I don't know when it was. I can't remember when it was, but it used to just be adjusted gross income, and the government said, well, we want to count other forms of income as well for this calculation. So we add it back in, or the tax code added back in a couple of other items. So it's based on your modified adjusted gross income, not your taxable income, not your adjusted gross income, but your modified adjusted gross income. And the two big contributors that I see for IRMAA are RMDs, required minimum distribution. This really sneaks up on people because of the way IRMAA is structured. It has a 2-year look back. So what that means is, if your income levels are higher and they trigger IRMAA, and again, I'm going to go over the brackets in a moment, but if they trigger the IRMAA brackets, the IRMAA surcharge brackets, I should say, in 2024, you won't be assessed that until 2026. So it can really sneak up on you if you're not planning for this. And I have to tell you that folks who are in their 50s, in their early 60s, this is likely not even on their radar. Taxation of Social Security, many people don't think about that. Income-related monthly adjustment amounts, the IRMAA surcharge, potentially much higher taxes than you're planning for. These are the things these critical items that you always hear me talk about that people aren't paying attention to. They were kind of taught the incorrect way before, and maybe if they knew these critical items in the past, they would have made changes and done things differently. But I'm hoping that you learn these items, these critical items now, and you can make adjustments, because RMDs, required minimum distributions, now under current law, when you reach 73 years old, you have to start taking distributions from your IRAs, and the government tells us exactly how much you must take from your IRAs. And if you don't take it, you're penalized. You're penalized 25% of what you should have taken, and that can be reduced to 10% if you rectify the missed distribution within 2 years. But still, it used to be 50%. Until last year, it was a 50% penalty. So they've gotten rid of that, thankfully, but still 25% is terrible, but 10% still stinks. So you can't avoid these required minimum distributions unless you do some really good planning around it. But this is probably one of the biggest contributors to this sneaky tax of IRMAA. And don't think for a minute that IRMAA is not a tax. You know, this is money they either keep out of your Social Security check if you're paying for your Medicare through Social Security, or money you have to send back to the government for these Medicare costs. These are the costs of your Medicare premiums, and they're increased because of your earnings. And that, folks, is a tax, in my opinion. They can call it a surcharge, but it is still a tax. So that causes IRMAA. There are other things, but these are kind of the modified adjusted gross income is what it's based on. RMDs are the one that sneaks up on most people. Roth conversions. So you may be surprised to see me have this on this list, this Roth conversions. Well, Mark, you always talk about Roth conversions. Roth conversions are a great thing. You say it's a gift by the federal government that they allow us to convert from traditional IRAs to Roth IRAs. The amount that we'd like to convert, we just have to determine how much tax we want to pay to do that conversion in any given year. But Roth conversions add to your modified adjusted gross income. So any year that you're doing Roth conversions, you must consider the IRMAA effect. Now we have a calculator that we build out. We build it out in-house here, and my senior financial planner associate Emily Wheeler built out this calculator, and we call that actually our friend David McKnight really liked it, and I said, Dave, he asked if we could use it, and I said, Dave, you can use it, you can share it with the rest of the group, but we have to refer to it as the Wheeler calculator. So this is a calculator that we use to show the benefit of, if we're going to pay IRMAA during our periods of Roth conversion, is that better than paying it for the rest of our lives if we don't convert? Because at some point, again, you're going to have income coming out of your distributions, coming out of your traditional IRAs, regular income, pension income, capital gains, things like that. This all goes into this modified adjusted gross income. And I should add that in here. So I'm going to add that. Capital gains. So anything that comes out of that taxable bucket, we have interest, dividends, all of that all, of course, adds into modified adjusted gross income. That should be up here, modified adjusted gross income, and that adds to this IRMAA calculation. So Roth conversions is when you're doing Roth conversions, when you've got a plan for converting your funds from traditional IRA to Roth IRA, which is a good strategy for many people, you have to consider the IRMAA effect. And again, we kind of wash it through our financial plan to see what the effect is. We run it through our calculators, and we see it is not uncommon. Somebody might pay X number of dollars. I'm just gonna spitball it here. $35,000 of extra IRMAA cost during a Roth conversion period, but they still may end up saving $50,000, $80,000, maybe $100,000 of potential IRMAA charges over their lifetime if they didn't do those Roth conversions. So I hope that makes sense. If you want more information about the calculator, you can reach out to us at questions@attleborowealth.com. That's questions. It's right here, questions@attleborowealth.com, and we'll be happy to explain it to you. I can't share that calculator with you. That's our calculator. But if you're a client, you've seen it, you know it. So the next thing, what helps avoid IRMAA? So before we go into that, let's look at the IRMAA brackets. So here's the chart. This is the 2024 Medicare income planning chart. And this is a chart you can download from our website. So you go to our website at attleborowealth.com, and you can go to the Education and Resources tab, go down to the Slott corner. So this is Ed Slott's chart. I want to give Ed all the credit. There's some great information you should review here, information about Ed and his team. This is a webinar that I did with Ed some time ago. This is information about the Ed Slott Elite Advisor Group. I'm fortunate enough to be part of the Master Elite Advisor Group. But here are the tax tables. You can download 2024 and 2023 tax planning documents. This is where I pulled down this document. So you just click in there, you put in your email address, and you can download these documents. So feel free to do that while that's still available. So let me get the website back up out of here. So this is what I'm talking about with these IRMAA brackets. So I'm going to make this larger. So let me explain this to you. I hope everybody can see this. So if you're a single filer, so it starts over here with a single filer, and over here is married filing joint. So just like everything that I can think of in the tax code, the bracket's a little more generous. You don't hit these IRMAA surcharges as quickly if you're a married couple filing jointly. Single filers, you hit them much faster. And just like most of the tax brackets, it's just about cut in half, if not exactly cut in half. So what that means is if your modified adjusted gross income is $103,000 or less for a single filer, $206,000 or less for a married filing joint filers, then your surcharge is zero, and you pay $174.70 for your total premium Part B, your Medicare premium Part B. That's what the charge is this year in 2024. Now, as soon as, let's just work to clean this up a little bit. As soon as you cross over that $103,000 to $129,000 if you're a single filer, or $206,000, right? Just double it, to $258,000 for a married couple. Well, you have a surcharge. That's $69.90. If you're married, that's times 2, right? It's each one of you. If you're both receiving Medicare benefits, if one of you is 65 and one of you is 60, obviously it's only a surcharge for one of you, but that's $69.90 per individual who's receiving Medicare benefits. And folks, that's per month. So then your total premium for Medicare Part B is $244.60 per month per individual. And if you're using Part D as well, there's a surcharge of $12.90 for a total Medicare surcharge in that bracket. If you're just listening, I did air quotes when I said bracket. So for a total surcharge of $82.80. Now, I want to point something out to you. This $103,000 and $206,000 is not like your tax brackets. With your tax brackets, you remember let me make sure that you can see this. With your tax brackets, we refer to it as, a graduated cylinder here. As your income goes up, you go into these higher brackets. It starts at 10, 12, 22, 24, 32. So you pay tax at 10%, you pay tax at 12%. And if you land in here, only this little bit that we're talking about here, do you pay tax at 22%. IRMAA is not like that. This $103,000 or $206,000 for a married couple, folks, that is a cliff. As soon as you go to 103,001, you fall off of that cliff and you go to the next level. So there's no gradualness in this. I know that's not a word, but it's the word I'm using. So as soon as you reach $1 over that level, you are now in that surcharge bracket, and you picked up in this example, $69.90. So now let's move on. What if your adjusted gross income goes over $129,000 for a single filer or over $258,000 for a married filer? Well, now you're paying a surcharge of $174.70. So it's double, remember, per individual per month, for a total Medicare cost per month of $349.40 for Part B. If you're using Part D, that's $33.30.